As the world goes crazy, the price of gold has shot to all-time highs, with Donald Trump threatening Europe, Russia fighting in Ukraine, and China looking at Taiwan. Investors are considering gold for safety. This is the second massive gold rally that I've seen in my 18 years of professional investing experience, both on Wall Street and here in Europe. The price has shot up 85% since Donald Trump's election, far outpacing other assets such as stocks. So, in this video, I will explain how gold can protect you against certain geopolitical or financial risks, where it falls short, and whether now is a good time to buy. But I can only answer that last question if I understand why you want to buy gold. So let's look at the reasons to buy gold one by one. To understand the first reason, take a look at this chart. Since 2022, purchases of gold by central banks around the world have significantly increased. And what else happened in 2022? Well, of course, Russia invaded Ukraine. Whenever a major war breaks out, investors buy gold for its perceived safety and stability. But this time, there was another effect. In response to Russia's unprovoked aggression, Western governments froze assets that the Russian central bank held abroad, such as reserves of dollars or euros or dollar-denominated bonds. This sent a very clear message to other governments. If you hold assets in Western currencies and in Western banks, they can be frozen or confiscated at any time. By contrast, if you buy tons of physical gold and stick it in your own bank vault, no sanctions or political decisions can take that away from you. So that is what central banks have been doing, and that is the first reason you might want to buy gold, to avoid sanctions and confiscation. But is this a good reason for you and I to buy gold? Well, that depends, right? Are you likely to get sanctioned by foreign governments? Unless you're a Russian oligarch, probably not. A few years ago, I would have said that European investors didn't have to worry about this at all. But since Donald Trump got elected, he has already threatened to raise taxes on European investors to punish Europe for political disagreements. And the step from punitive taxes to capital controls or sanctions, well, it's unlikely, but it's not impossible. And that is before we even look at Trump's Greenland obsession and the threats of starting a military conflict with Europe. In light of all this, today, I believe it would be quite risky for European investors to hold all their assets in American stocks or bonds. Diversifying makes a lot of sense, and gold could play a role in your diversified portfolio. That said, before you rush out to buy some gold, keep watching, because there are also some reasons to be skeptical. But first, here's this. 2026 is going to be an intense time in the markets. If you're not a professional investor, it can be hard to keep up with all the headlines and figure out what is important and what you can ignore. That is exactly why I write a free newsletter for European investors. I share investing insights, personal finance tips, and market updates with over 100,000 readers from EU countries, the UK, Switzerland, and elsewhere. To sign up, just follow the link in the description. But okay, now let's look at a second reason to buy gold. In the 1920s, Germany experienced hyperinflation. Prices doubled every few days until the papier mark became worthless. You needed a wheelbarrow just to carry enough cash to pay the rent. But people who held physical assets like gold managed to preserve or even grow their wealth. Developed countries haven't seen hyperinflation of this kind in a very long time. The dollar, the euro, and the pound have been quite reliable. But the world did get a taste of high inflation just a few years ago during COVID. On top of that, many governments are struggling with high levels of debt, which could make it tempting to print money and inflate the debt away. And in America, Trump has been putting tremendous pressure on Jerome Powell, the chair of the US Federal Reserve, to lower interest rates. Experts warn that low interest rates at the wrong time could easily cause high inflation. So for many people today, the second reason to buy gold is to guard against inflation. But is gold actually a good way to stay safe from inflation? To understand the answer to this question, we must first explore why gold has been such a popular investment for thousands of years. Well, first of all, gold is really rare. There is 14 million times less gold in the Earth's crust than iron. It is very hard to find gold and very difficult to mine it. Making a gold bar or a gold coin requires a lot of people to work together. So If somebody possesses a lot of gold, that's obvious proof that they have wealth and influence. Second, it's durable. Gold doesn't corrode, it doesn't rust, it doesn't otherwise degrade over time. So that makes it perfect for preserving wealth. Third, well, it's beautiful. People love using it for jewelry, and it's got thousands of years of history as a cultural icon. And fourth, nobody can inflate it away. Gold is a chemical element. The quantity available on Earth is more or less fixed. Scientists have come up with some ways to create gold through nuclear processes, but this remains very difficult and expensive. So that means nobody can just print a whole bunch of gold and make it worthless like you can with a paper currency. Because of all these reasons, gold has kept its value remarkably well over the really long term. One famous example is that a cow in ancient Rome cost approximately 1 ounce of gold, depending on the time period and, of course, the cow in question. Today, a cow costs around $3,000, and as it happens, that was the cost of an ounce of gold just a year ago. So basically, in gold terms, the price of cows has been remarkably stable for thousands of years. This shows that if your goal is to preserve value over centuries, gold is a fantastic choice. But if your time horizon is shorter, the picture is less inspiring. Most recently, global inflation spiked during COVID in 2021 and 2022, but the price of gold stayed flat, and then it even fell for much of 2022. Far from protecting investors from inflation or market crashes, gold went down in lockstep with other assets before only starting to rise significantly in 2024. If you go back further in time, between 1980 and 2000, the dollar lost more than half of its purchasing power. There was significant inflation. But over this same period, the price of gold fell by more than half in dollar terms. And if you adjust for inflation, the total loss of value for a gold investor was 80%. So that's not a very good level of protection. In 2013's paper, The Golden Dilemma, Claude Erb and Campbell Harvey did a detailed historical study and showed that gold has been an unreliable inflation hedge in all but the longest time periods. Now, to be clear, if hyperinflation happens and your currency totally loses value, then of course you will be happy that you had some savings in gold. You will preserve at least part of your wealth. But if your goal with buying gold is to protect against normal levels of inflation, it's really not very helpful. A third and related reason to buy gold is to guard against currency risk. This is when one currency falls in value against another, like how dollars fell in value against euros in 2025. So a lot of people bought gold to kind of hedge against this dollar risk. But you have to keep in mind that in the short to intermediate term, currency exchange rates fluctuate for many different reasons, such as trade imbalances, interest rate differences, tariffs, geopolitical conflicts, and more. And over the long term, currencies get stronger or weaker to a large extent based on relative inflation levels. So for example, if America consistently has much higher inflation than Switzerland, that means that over time, $1 will be able to buy much less than 1 franc. So you would expect the dollar to gradually lose value versus the Swiss franc, which is what has already been happening for many years. So at the end of the day, if you want to guard against currency risk, that is a lot like guarding against inflation. If you're worried about the US dollar falling in value, sure, you could buy some gold. It does seem attractive because if the dollar falls, the price of gold, when you express it in dollars, is going to go up. But then again, so does virtually anything else. If the dollar is getting weaker and you have some foreign real estate or you have some other kind of asset that has an international market, when you translate the price into dollars, it's going to look higher, right? Because $1 is worth less. So in the big picture, I'm not particularly convinced that gold is attractive as a hedge against the falling dollar or any other currency. Next up, let's look at a reason for buying gold that I actually think is pretty sensible. To explain it, let me take you on a quick tour of my office. So here's the studio, and this is the rest of our beautiful office space here in Riga, Latvia. And if you look 200 kilometers in that direction, you've got the Russian border. Ever since the war in Ukraine broke out, people have been asking me every week, what if Russia attacks us? What happens to our banks? Is my money safe? And my answer is always twofold. First, I'm very optimistic that this is not going to happen. I think it's a low probability. But that probability is not zero. So second, If war does break out, all bets are off. You cannot count on local banks or brokerages to function normally. Internet access can be disrupted. Banking and brokerage operations can stop. Assets can get confiscated. One recommendation I always make is don't keep everything in one country. Have some bank and brokerage accounts in different countries. But it can also make sense to own some physical gold, maybe some gold coins or jewelry that you can carry around on your body if times get tough. Think of it not like an investment, but an insurance policy against war or revolution. So that would be the fourth reason to buy gold, as insurance. Okay, but now for the fifth reason. Some people buy gold just to make a profit. They think that gold will make them richer. Well, if you've been paying attention, you should realize by now that that makes zero sense. I mean, think about it. If an ounce of gold bought a cow 2,000 years ago, and it still buys a cow today, and if that same ounce of gold will buy a cow 100 years from now, how is holding gold going to make you rich? The very fact that gold is an excellent, stable, long-term store of value also demonstrates that it's a poor long-term investment because it simply doesn't grow. At the end of the day, gold is a chunk of metal. You can buy some and it's just gonna sit on the shelf, doing nothing for you, creating no economic value, paying you no income. Your only hope of making a profit is if the price goes up. By contrast, if you buy a house or apartment and rent it out, you will not only have a valuable asset, but you can also get rental income. If you invest in a diversified stock portfolio, you can co-own hundreds of companies globally where millions of people go to work every day to serve their clients and earn a profit. With real estate and stocks, you can make money even if the price stays flat or goes down, as long as you're getting rental income or dividends. Now sure, over the past few years, gold has shot up faster than any other asset. But when you look at long-term data, returns on traditional investments like stocks and real estate have been much higher than returns on gold. At the same time, the price of gold has been just as volatile as the stock market, meaning that you would have seen a lot of risk in your portfolio, a lot of ups and downs with a much lower reward. All right, but before you start to think that I'm a gold hater, let's cover the sixth reason to buy gold, which can be perfectly valid: diversification. Professional investors love to own different assets with what are called low correlations. This means assets that go up and down at different times. Historically, gold has had low correlations with other asset classes such as stocks or bonds or real estate. I won't get into the mathematical details, but this means that adding a bit of gold to your stock and bond portfolio could significantly reduce the risk of the portfolio while only mildly decreasing the expected return. That said, gold should still be only a minor part of your portfolio. Different experts and studies suggest maybe a 5 to 15% allocation. Any more than that, and it's likely to become a drag on your results because, again, gold does not have a high expected return over the long term. So, in short, gold can be perfectly sensible as a portfolio diversifier. I personally don't use it, but if you have a small gold allocation in your portfolio, I think it's very reasonable, as long as most of your money is still in diversified stock and bond ETFs. All right, but if you do want to buy gold, is now the right time? Over the past few years, we have seen a tremendous run-up in gold prices. To some investors, that's an exciting signal to jump in. But others with longer memories are asking, what if it's a bubble? In 1980, gold had just experienced 10 years of tremendous returns. A lot of enthusiastic investors bought gold, and then they experienced 20 years of falling prices. The reality is, nobody knows where gold will go tomorrow. It could keep climbing or it could fall. Predicting price movements is incredibly hard. You just have to be aware that there's plenty of risk. So, if you are adding gold to your portfolio, it should be for the right reasons. Treat it as a long-term commitment to diversify your portfolio, not as a speculative bet to make quick profits. And now we get to one final question. How exactly do you invest in gold? Where do you buy it? And the answer depends on your goals. If you want gold as insurance against war or revolution, then your best bet is probably to buy some physical coins or bars from a reputable source like the Austrian Mint, for example. Just make sure to think about how you will store the gold and protect it from thieves. If you're confident that you will be free to travel, you can also buy and store gold in high-security vaults in places like Switzerland or Germany or Singapore. But if your goal is just portfolio diversification, physical gold is probably too much trouble. Instead, you can invest in gold using an ETC, an exchange-traded commodity. This is basically a financial contract in your brokerage account, which will go up and down together with the price of gold. To buy a gold ETC, you follow the same process as when buying any stock ETF through your broker. If you want to see how that works, watch this video next. I call it the ultimate guide to ETF investors in Europe.